Good morning, everyone. Welcome to the Q3 trading update call for the Sage Group. Your presenter today will be Jonathan Howell, Chief Financial Officer, who is joined by James Sandford, Head of Investor Relations. After the speaker's presentation, there will be a question and answer session. To ask a question, please press star 11 on your keypad. To withdraw your question, press star 11 again. Please be advised that today's conference is being recorded. I would now like to hand the conference over to Mr. Howell. Please go ahead.
Thank you, and good morning, everyone. Welcome to Sage's Q3 trading update. I'll briefly run through the key numbers and the performance of the business, and after that, we can open for Q&A. Sage has performed well in the first 9 months, delivering good levels of growth in line with our expectations. Total revenue for the group increased by 9%. To over 1.8 billion, as we continue to scale the business in all regions. In North America, revenue grew by 11% to 846 million, with a strong performance in Sage Intacct, together with continuing growth in Sage 200 and Sage 50. In the UK/IA region, revenue grew by 9% to 539 million. This was driven by strong progress in Sage Intacct, together with further success in Sage Accounting and Sage 50. And in Europe, revenue increased by 7% to 477 million, with good growth across our cloud solutions, including Sage 200 and Sage X3. Turning now to the main performance drivers. Sage Business Cloud grew by 13% to over 1.5 billion, reflecting good strategic progress as we further expand our global cloud solutions. This includes cloud-native revenue, which grew by 22% to 645 million, and now represents more than a third of the group. Recurring revenue increased by 10% to over 1.8 billion, driven by continued momentum in ARR. This includes subscription revenue growth of 11%, resulting in subscription penetration of 83%, up from 82% last year. For Q3 standalone, total revenue increased by 9%. To 620 million, driven by continued growth across Sage Business Cloud. On an organic basis, total revenue for the first 9 months increased by 9% to over 1.8 billion. So finishing on the outlook, with growth so far in line with our plan, we reiterate our full-year guidance as set out at the half year. Organic total revenue growth is expected to be 9% or above, and we expect operating margins to trend upwards in FY25 and beyond. So in summary, Sage has performed well throughout the first 9 months, in line with expectations. And we enter the final quarter with good momentum. Thank you, and now let's open for questions.
Thank you. As a reminder, if you wish to ask a question, please press star 11 on your telephone and wait for your name to be announced. Please stand by while we prepare the first question. The first question comes from Adam Wood at Morgan Stanley. Adam, your line is open. Please go ahead.
Hi, good morning, Jonathan. Thanks for taking the question. It does look as if we've had a little uptick on the organic top line for you after a few quarters where we've had, sort of very gentle deceleration. I wonder if you could talk about, what that reflects in the environment and any color you can give in particular areas where you're seeing improvement to drive that, please. Thank you.
Yes, thank you, Adam. So yes, we've seen a slight uptick, as you say, in the organic performance. Nonetheless, we've seen underlying revenue growth of 9% in Q3 year to date. That, as I said in the introduction, is very much in line with our expectations. We've seen solid growth in North America, with total revenue up 11%. That's very much in line with the first half. And as I said, we've seen a very strong performance from Sage Intacct, with good support from Sage 200 and Sage 50. Across North America now, we're sustaining double-digit growth off an increasingly large base. UKIA, strong revenue performance, up 9%. Similarly, that was in line with the first half. We've got Sage Intacct in this region scaling rapidly now, particularly through NCA. And then in Europe, revenue's up 7%, just slightly down on the first half, which was 8%. And that's good levels of growth across the whole Sage Business Cloud. And then in terms of the backdrop, during the first half, the macro environment for us was broadly stable. And as we said at the results call in May, it's since become a bit more volatile and uncertain. But despite that, we have seen no material changes in customer behavior at the Q3 mark. And so, it's just worth reminding ourselves that Sage is a diverse business, both in terms of geography and product, and therefore has inbuilt resilience. We're in a structurally growing sector where SMBs are increasingly adopting digital tools, and we position the business well to continue to benefit from these trends. So I hope, Adam, that answers your question.
That's a great rundown. Thank you.
Next question comes from Toby Ogg at JP Morgan. Your line is open. Please go ahead.
Yeah, hi, morning, Jonathan. Thanks for the question. Perhaps you could just give us just an update on the ARR development in 3Q and just how the organic sequential looked in 3Q this year versus 3Q last year. And I also know, just looking forward, there's a difficult comp on the ARR coming up in Q4, just given the strong Q4 last year. So just anything for us to think about here heading into Q4 as well on the ARR side. Thank you.
Yeah, so just to recap on the year so far in terms of sequential growth. In Q1, it was about 2%. In Q2, it was about 2.5%. And then in Q3, it was about 2% again. So we continue to have good momentum, and this underpins our confidence in our full-year guidance, which we reiterated this morning. If you're looking at a comparison against the prior year, Q3 sequential growth in the prior year was a little above 2%. So this year's growth is just slightly below last year's level. But importantly, I think this is very much within the normal quarterly variation that we'd expect to see, and certainly remains consistent, as I've said, with the guidance that we've reiterated. And then on Q4, yes, it's a stronger comp that we're running into. But given what I've just explained in terms of the momentum that we've seen during the course of the year, we're confident in the guidance that we're giving.
Understood. Thank you.
Please stand by for your next question. The next question comes from Kai Korschelt at Canaccord Genuity. Your line is open. Please go ahead.
Yeah, thank you. Good morning. Thanks for taking my question again. I have a question around Intacct, particularly in the US. So appreciate you said there's no major change in buying behavior, but it looks like quite a few software companies more in sort of enterprise segments seem to have seen a bit of incremental hesitation in the second quarter, particularly with the sort of tariff uncertainty. Yeah, if you have any color on whether you've seen anything similar, that would be super helpful. The second question was just around Xero. They acquired a bill payments platform recently. I think Intuit has something similar. Just wondering if you think more strategically about your tech stack. Do you think you have all the ingredients, or would something like sort of payments or perhaps MarTech might be a bit more attractive? And I appreciate you've been buying sort of other functionality bits over the last 12, 18 months. Any color here would be appreciated. And then I have a follow-up. Thank you.
Yes. So just in terms of the macro backdrop, I've just covered that in one of the previous questions. But just to provide a bit more detail, we delivered now organic total revenue growth of 9 to 10% over the last 3 years. And whilst we've been doing that, we've been improving the business mix. Cloud native revenue is now over a third of total group revenue, and that is growing at over 20%. And then specifically on Intact, in the US now, we have ARR approaching 500 million, and that's growing at over 20%. Internationally, in other words, ex-US, we have ARR of more than 60 million, and that's growing at over 50%. And we will continue to invest in these core products of ours and the platform, which again, will give us momentum as we move into FY26. And then lastly, in terms of M&A, as you know, M&A is a very important part of our strategy. It provides us with complementary technology and skills. And during the course of this year, we've completed 2 small bolt-on acquisitions. Last October, we bought Force Manager, which is the mobile Salesforce management tool. And then earlier this week, we've announced the acquisition of File Technologies, which is an expense management platform for US SMBs. So to answer your question, we're constantly looking for the appropriate technology, the appropriate skill sets, which we can then deploy against our significant international customer base. And that will remain a critical part of the strategy as we move forward. Thank you.
Thank you. Could I just double-check on the 200 million buyback extension? Is that largely done now?
Yes, I think it will complete today. So we have now completed the total 600 million share buyback. We've returned 1.6 billion of capital over the last 4 years. That's reduced the share count by about 16%. It's done very much in line with our normal capital allocation policy. It's probably just worth reiterating that. The first priority is organic and inorganic growth, to put capital behind that. Secondly, to pay progressive dividends. And then we will return surplus capital if we have no other need for it. And that's what's driven our sort of allocation decisions between M&A and capital return. Thank you.
Perfect. Thank you.
Please stand by for your next question. Next question comes from Frederic Boulan at Bank of America. Your line is open. Please go ahead.
Hey, good morning, Jonathan. If I can ask a question around the competitive environment, especially in the US, if you've seen any changes, especially around Intuit. And then secondly, on GenAI, if you can spend a bit of time on the reception to your price points in the UK, where you've launched a couple of offers. What has been the reception, the appetite, the feedback? Thank you very much.
Yes, in terms of the competitive environment, we've seen no material change during the course of Q3. And you referenced Intuit. And I think, as Steve said at the half year, we believe in what we can see. That is very much focused on retention of their existing base. But overall, across the group, we have not seen a material change in the competitive environment. Then in terms of GenAI and in particular Copilot, which is our product, we recently expanded the availability of Copilot now in the UK. It is now available to all direct customers on all 3 tiers of Sage Accounting in the UK, and we continue to make it available to Sage 50 customers on a phased basis in the UK. So overall now, Sage Copilot is now available to about 150,000 customers in the UK, and we're going to continue rolling out certain features for other products, including Sage Intacct. And then in terms of pricing, I think we said it at the half year, but it's probably worth repeating it. We are charging more for the additional Copilot functionality. We're doing that as part of the annual price rises and making sure always it's a fair value exchange. So far, Sage Accounting and Sage 50 in the UK, we put those prices up by about 25% and 12% respectively. This has supported revenue growth at the Q3 stage, but it is a small impact. It is not material at this stage. I think as we look forward, there is future revenue opportunities here. Firstly, the broader rollout of Copilot to other territories, not least the US. And then secondly, there are strong upsell opportunities through additional user licenses or services. So the Copilot and Gen AI is very much on track, with the plans that we set out at the half year stage. Thank you.
Thank you very much.
Please stand by for the next question. The next question comes from Johann Schaller at Deutsche Bank. Your line is open. Please go ahead.
Yeah, good morning, Jonathan. Thanks for taking my question. I was wondering if we could zoom in a little bit more on the dynamics in North America, particularly around Intacct. I mean, you've made obviously very strong progress in the target verticals like not-for-profit or construction, but maybe outside, the progress has been in certain quarters a bit more challenging in other verticals. So what are you seeing more recently here in terms of winning new customers in verticals where you haven't been so strong historically? And then as a second question, I was wondering if you could just give us your latest thinking on the margin trajectory in the second half of the year, given what you're seeing in the market. How are you thinking about balancing growth against profitability? Thank you.
Yes. So in terms of the margin, there's no change to what we said at the half year results. Sage's margin at the first half was 23.2%. That was up 140 basis points on an underlying basis. We continue to guide to 50 to 100 basis points of margin improvement over the full year. And this means that we expect a further slight improvement in the margin in the second half. In terms of the performance of Sage Intacct, you're quite right in saying the question. We've continued to focus on the verticals in North America where we are strongest. That's not-for-profit, construction, software, financial services, and healthcare. But as we called out at the first half stage, we are now working hard on newer verticals, and the particular focus that we have is on manufacturing and distribution, which has the largest TAM for our business in North America. We're serving our larger customers at the top end of the scale through X3, and we've been delivering 15% or so growth for the last 2 years off a base of about 120 million or so. And then we're beginning to serve smaller mid-market customers through SDMO, the new product, and also Intacct. It's early days, but it's moving in the right direction. And as I always say, these new products and new initiatives take time to come through. But it's all going in line with our plan.
Great. Thank you.
That's all the time we have for questions. I will now hand the call over to Mr. Howell for closing remarks.
Yes, as ever, thank you very much for your time, attention, and good questions. For the rest of today and indeed the rest of the week, James and the IR team will be available to take any additional questions that you may have. Thank you very much.
That concludes today's presentation. Thank you for participating. You may now disconnect. Speakers, please stand by.